Most real estate investors think depreciation is just an accounting line item, something their CPA handles and they don't need to worry about. That belief alone is quietly costing you tens, sometimes hundreds of thousands of dollars, whether you realize it or not. Because here's the truth no one tells you. Depreciation is not optional, and it isn't just a write-off. It's a mandatory IRS system with rules that lock in your outcome the moment you buy, place in service, or use an asset. Get it wrong, and you don't just miss tax savings. You create recapture risk, audit exposure, and permanently lost opportunities you can never fix later. In this video, I'm going to break down exactly how depreciation works, where most real estate investors go wrong, and why treating it like a tax prep issue instead of a tax planning decision is one of the biggest wealth leaks in real estate. Watch this all the way through, because once you understand this system, you stop reacting at tax time and start designing your tax outcome on purpose. Hi, I'm Sherry Ayland, and I help high W-2 earners and real estate investors cut or completely eliminate their tax bill using my Zero Tax Blueprint. To find out if you're eligible, click the link in the description. In the Zero Tax Blueprint world, depreciation is one of the most powerful wealth-building tools the IRS has ever created. So today, I want to break down in plain English what depreciation is, what qualifies, how the IRS decides how fast you can write things off, and why depreciation sits at the core of the smart tax planning and the Zero Tax Blueprint. Let's start with the basics. Depreciation is the IRS allowing you to recover the cost of an asset over time. The tax code literally says that you're allowed a reasonable deduction for the exhaustion, wear and tear, and obsolescence of property used in a trade or business or held for the production of income. In plain language, this means you buy an asset for your business or income-producing activity. The IRS acknowledges that it won't last forever. So instead of deducting the full cost all at once, you recover that cost over a period of time. Now, that recovery is based on three things. First, the asset and its basis, which is generally what you paid for it. We'll discuss basis more in a later video. Second, the method of depreciation that applies to that type of asset. And third, the useful life the IRS assigns to that asset, which is also called the recovery period. Change any of these and the tax outcome changes. Now, let me take a moment to clear up a common point of confusion. You've probably heard words like amortization and depletion thrown around, and maybe not understood what those mean. Depreciation, amortization, and depletion are all the same concept applied to different types of assets. Depreciation applies to tangible property, things like buildings, equipment, furniture, and vehicles. Amortization applies to intangible assets, things like goodwill, trademarks, patents, startup costs, and loan costs. And depletion applies to natural resources like oil and gas, minerals, timber. All three are simply methods of spreading deductions over time, but depreciation is where all of the tax planning opportunities live, especially with real estate. Now, let's talk about what can actually be depreciated. For an asset to qualify, it must be used in a trade or business or income-producing activity like real estate. Personal use assets do not apply. If something is used partly for business and partly for personal use, only the business use percentage can be depreciated. I will talk to you more about this in listed property at the end of this video. Now, let's talk about the system that the U.S. uses to calculate depreciation. The current system is called MACRS, the Modified Accelerated Cost Recovery System. Inside MACRS, there are two main systems. The first is the GDS, or General Depreciation System, and this is the default system, and it allows for faster depreciation. The second is the Alternative Depreciation System. The Alternative Depreciation System uses straight-line depreciation over longer recovery periods. ADS is required in certain situations, such as property used outside the United States or tax-exempt use property. Now, here is a critical planning point. Assets depreciated under ADS are not eligible for bonus depreciation, which we will go into shortly. That alone can be the difference between massive tax savings and none at all. For example, if you buy a short-term rental in another country, you cannot take advantage of bonus depreciation. Now let's talk about recovery periods. The recovery period is simply the number of years over which the IRS allows you to recover the cost of that asset. Some common examples are 5 or 7 year property, which usually applies to equipment, furniture, and vehicles. 15-year property, which includes land improvements like parking lots, fencing, and landscaping. Now, real estate is depreciated over 27 and a half or 39 years. So for the 27 and a half period, that applies to your residential real estate, and 39 years applies to commercial real estate. Now, let me make one point here that most people don't understand, and that is when it comes to real estate, depreciation is based on the use of the property, not the type of the building. So if you buy a residential property that you use as a short-term rental, that depreciation is spread out over 39 years because you've basically made that into a commercial property running a commercial business. Whereas if it was a long-term rental, it would be depreciated over 27 and a half years because it is technically residential real estate. Now, these are IRS assigned lives, not how long something actually takes to wear out or how long it lasts. And this is exactly why strategies like cost segregation work, because not everything inside of a building actually has a 39-year life. Now, let's get into what everyone really cares about: special rules and allowances, or accelerated depreciation. There are two categories here: Section 179 and bonus depreciation. Section 179 allows you to elect to expense the qualifying property in the year it's placed in service for 100% of the cost. It is flexible. You can elect which assets it applies to, but it is limited by business income and generally cannot create an operating loss. Bonus depreciation works differently. Bonus depreciation is automatic unless you opt out, and the percentage is preset by law. Starting in January 20th, 2025, that percentage is 100% and is permanent. But prior to that, it was 40% of the cost. Bonus depreciation can create a loss, and it's one of the key tools behind strategies like short-term rentals, cost segregation, and self-rental planning. Understanding when to use Section 179 versus bonus depreciation is a major tax planning decision, not a tax prep decision. Now, let's touch briefly on listed property. Remember in the graphic we showed earlier about business versus personal property. Listed property is the personal property that the IRS knows you may personally use as well as for business, like cars and computers. So they let you depreciate it, but only if you prove business use and follow stricter rules. There are 4 points here. Number 1, the more than 50% business use test. To use accelerated depreciation, the business use must be more than 50%, and this test is applied each year. Secondly, there are depreciation limits, specifically for luxury auto rules. Passenger vehicles are capped annually, even if it's used 100% for business. For example, the 2025 first year limit with bonus depreciation is $20,200. Heavier vehicles may qualify for the 100% deduction. This is why vehicle strategy is one of the most misunderstood tax write-offs. Now, third is the recapture risk. This is the gotcha. So if in a later year your business use drops to under 50%, the IRS requires you have to add back the difference between accelerated depreciation you took and what straight line depreciation would have been. Now, there are also strict record keeping requirements. For listed property, reasonable estimates don't cut it. You must keep contemporaneous records such as mileage logs, usage logs, and dates, purpose, and business relationship. One last concept that is important to understand is converted use property. When you convert a personal use asset to business, the basis for depreciation is the lower of adjusted basis or the fair market value at the time of conversion, the lower of. Again, we'll be going deeper into basis and adjusted basis in a later video. Now, you cannot use Section 179 on a converted use property, but bonus depreciation may still be available. And that distinction alone can change the outcome of a tax plan. So here's the big takeaway. Depreciation is not just an accounting entry. It's a planning tool. It's a cash flow strategy. And it's a cornerstone of building wealth the smart way. When you understand recovery periods, depreciation methods, conventions, and special rules like bonus depreciation, you stop reacting at tax time. and you start architecting your wealth on purpose. This is why depreciation sits at the foundation of the zero tax blueprint. If you want help applying this to your specific situation, whether that's real estate, business ownership, or high W-2, that's exactly what I do. Make sure to like and subscribe. And in the next video, we'll break down cost segregation with bonus depreciation the right way, without the hype and without the mistakes.